Several names saw sharp moves on the back of earnings. We'll discuss where options traders appear to be betting those stocks are headed today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic, sponsored by OptionPlay. Open Mic, as the name implies, is when we open up the chat and take your questions and we can walk through some of your trades together. Be sure to like, subscribe, hit the notification bell, and most importantly, ask your questions in the chat. I am not a mind reader, so I won't know what it is you want to talk about unless you throw those names and trades in there. But before we get to that chat, let's take a look at some of the busier contracts today and what's propelling all the volume. And first on the list is Vistra Corp. That is ticker VST. The Dallas-based utility saw adjusted EBITDA of $790 million, which they reported today, and that comfortably exceeded street expectations of $680 million. And somewhat astonishingly, Vistra, a utility, is now up 132% year to date. So this name has now actually been newsworthy for a while. It wasn't just earnings. This company got special mention from Dan Loeb, actually, on a recent letter. And basically what's going on here is, of course, while a lot of people are playing in the AI space, some are recognizing that all of this AI compute and the data centers that are going to be necessary to do a lot of this work are going to take a lot of power, actually, to use. And so this is a name that's kind of relevant in that space. We should probably be starting to look at some of the utilities that are getting picked up by some of the folks that are making a play on this. But this was a name that popped, I think. Let's take a look, actually, at how much this one did. And by the way, somebody had made a mention that they would prefer to see candle charts when we put up price charts. So I am going to do that. We have two techniques to do this. Obviously, the OptionPlay app also can do this. So I'm actually going to try to bring up, oops, that's not what I wanted. I'm going to try to bring up the chart here, and I'm going to try to put a candle in it and see. So be sure to comment about whether or not this is helpful or not. So first things first, I'm going to pull it up on my Bloomberg terminal first while I try to work on this on the other side. So this is somewhat astonishingly Vistra Corp year to date. Like I said, it's up 132%. I think it's close to a triple over the course of the last year. Closed pretty close to the highs. And let's just take a quick peek at what was going on in the options for this one today. So it traded 100,000 contracts. That's about 5 times the average daily volume. And interestingly, you don't typically see utilities trading a huge amount of volume. When I'm looking at unusual volume, such as we got today, and after we've had news, the first thing I will do is look to exclude any of the activity that's going on that might be unwinds related to the big move that we saw in the stock. So first things first, as we try to do that, we know that the stock is obviously trading at its all-time highs. So the things that we're going to be looking to ignore are any of the really deep calls. It's not going to be a lot of deep puts at this point, and the reason there's not going to be deep puts is because the stock's trading on the highs. So there hasn't been a whole lot of volume related to the stock's rally through that. So if we look down here, we can see January 60 calls out to next year. Those are deep calls. We can see that there was a decent amount of open interest. So the first thing I'm trying to take a look at is, okay, what is very likely indicative of new opening interest? And we can actually see that it's the May 95 calls that expire next week. There was some open interest on this even coming in today, about 2,700 contracts. But there was 11,000 contracts that traded in here today. These expire a week from this coming Friday. Normally, if we don't have an event, the first thing I will do to try to establish whether or not this is opening buyers or opening sellers is take a look at the change in implied volatility, which we can see is clearly lower, which would normally indicate that that selling flow, and that's just like the first sort of thumb in the wind check that you can do. But in this case, we know that that's not reliable. Why is it that we know that that's not a reliable way to check? Well, it's because an event just came out, and the very first thing that happens after an event comes out and we get new information coming into the market, what's the first thing that happens to options prices? Obviously, they're going to respond to the price movement in the stock, but the implied volatility is going to come down, and it's going to come down sharply. That's what we refer to as the volatility crush. That is because the options prices were elevated going into the event, anticipating event variance, and once that event has come and gone, that event variance is going to get sucked out quite promptly. So the implied volatility is not a good indication on its own after that event of whether or not these options were bought or sold. So we actually need to drill into this a little bit more and see what was actually happening intraday. Oops. And of course, I have a typo here. And so I want to see what's going on just during the day in these options and try to take a look at where most of the flow was and see whether we got any institutional activity. And the short version is, it appears that right around here, right around 1:50 this afternoon, it looks like we got a 7,000 lot that traded. We can see that. And actually, let me hone in on this chart a little bit more. I'm just going to elevate this one up. Okay, so I'm just going to show the intraday trading volume. Okay. And here's what we're looking at. It's this big spike down here. We can see that there was a big block of these things. That traded right around 150. So now we can take a look at time and sales and see what that was all about. I'm guessing that traded, it depends on which exchange. So on some exchanges, this will print as a single piece. On other exchanges, you're going to see it as a number of big blocks as the trade is divided up amongst various market makers. But the first thing I'm going to do is say, well, that looked like 1,000 lots. So sure enough, okay, here we have it. This was so this traded on their own. 6,600 traded 75 cents at 151.54. So we're going to make a note of that and what we want to see next. Okay, what was the market when those traded at that price? 151.54, just bearing that in mind, 75 cents. So now I want to take a look at what the market in those options was at that time. And so I can actually just take a look now. We're going to go right to this time of day and see what we have. This is when that trade took place. Had some intermarket sweeps in here. And why did we have those? Because at 1351.54, the market for those call options was 90 bid at 95 cents. Then we started seeing some intermarket sweep orders come in at 90 cents and then hit it at 80 cents. All right. And then we saw that print take place at 75 cents. So what does this tell us? That 6,600 lot, so 276 trade 80, a bunch trade 90, that looks like an institutional seller to me. What is going on here when you see this kind of flow? So the options markets work a little bit different than equity. Equity markets, when we have block prints, so most of you will probably know that my background was initially in market making and then block market making, which meant that when mutual funds and hedge funds were looking for a size market on the wire, meaning that they make a call and say, okay, we need to trade a big block of options contracts, that they would call their salesman or their sales trader, and then salesman or sales trader would call me and say, okay, where do you make a price? So on the equity side, you have something called Reg NMS. Reg, what does that mean? What it means is that when they're trying to trade big blocks of stock, you have to first satisfy the top of the book, what's essentially the lit market. So the lit market is protected interests. So if you are out there and you're looking at, we're looking at Vistra stock. So we'll just look at the price as of the closing prices. So the stock's $89.20 at $89.28. Somebody comes in and says, okay, I want to sell 100,000 shares of Vistra Corp. And I see the market as 89.20 bid. A trader might say, I will pay you 88.5 for 100, or I will protect you at 88.5. And what that means is they will satisfy your sell order at $88.5. But what we can see is that there's 14,800 right now that's 89.20 bid. So what would happen is, assuming that the person just said sold and they wanted to get this done very quickly, 14,800 would trade 89.20. If we were looking at a level 2 quote, there'd probably be a bunch of other protected interest. Stuff would trade down there. And then whatever was left, okay, let's say that 27,000 trade at some price between 89.20 and 88.5. I would end up buying the balance if I was the equity trader. On the option side, it's very similar. So what we were seeing when we were looking at those time and sales, most likely, was that you had a seller of 7,000 and they were selling them at the market, and then a market maker, block trader, or maybe it was just the regular market making crowd. But basically what ended up happening was they filled the balance. So they were selling them at 90 and 85, 80, and then they ended up selling the balance at 75. And that was new opening interest. And we can see that because the entire open interest coming in today on those options, on the May 95 calls, was just 2,700 contracts, and that was a 7,000 lot. So we know this was new opening interest, and it looks, to me at least, like this is a seller. So who would be a seller of the May 95 calls? Well, it's probably not somebody who's just looking to, sell those things naked, right? And it's probably not a mutual fund. This is almost certainly going to be a hedge fund or somebody like that who probably has owned the stock, has seen it through this most recent rally, and is now looking to squeeze a little extra premium, or might even be willing at this point to be taken out of their position. Is it green light? Is it Dan Loeb, who was talking up the stock in one of his investor letters just a week ago? Maybe, maybe not. There's some other candidates on the holders page who could potentially be, what we're looking at are hedge funds here. So, 0.72, Stevie Cohen's shop, place like that. They might be interested in potentially selling options. It's not going to be Fidelity or any of these guys, besides which their positions are already way too large for something like that. So what you're going to be looking for is potential sellers who are going to have at least 700,000 shares, because we know that they sold 7,000 contracts. And I actually just said green light, but actually it's Third Point. Dan Loeb is with Third Point, and they're right here, right? So Third Point has 4.6 million shares. They had added 1 million over the course of that quarter. What a great trade, huh? So as of December 31st, they own 4.6 million shares, and the stock has been more than doubled since then. So any of you who are watching who are Third Point investors must be pretty pleased with that. But that is what I'm guessing is going on here, is that it's probably somebody like Third Point, or somebody with a similar thesis who is now thinking, okay, I'm just about done. I'm ready to take my profits. So what does that tell me? It tells me that for all of the smart money that has plowed into this stock, and boy, have a couple of them done really well. Obviously, Geo, Third Point, 0.72, Merriweather, it's interesting. Druckenmiller, who was just on CNBC, I think it was either earlier this week, tail end of last week. That's the Duquesne family office, by the way. That's down here. number 28 on this holders list. But they see potentially, at least between now and May 17th, that the upside is perhaps a little bit more limited. This could also potentially, from my point of view, though, be an opportunity for those who want to have a longer-term hold in this, because now that the implied volatility has come in, and it has come in quite substantially, you might go out and start thinking about, and maybe we can pull it up on the OptionPlay app here. So I'm just going to toggle over to that. This is a situation where you might just think about doing something similar and get into a poor man's covered call. And let me see here. I am going to, bear with me a second, I'm going to just toggle this around here. I have to bring up the OptionPlay app so we can sort of walk through some trade ideas together, how that might look. There we go. I think I have OptionPlay up now. Yeah, and I am going to actually, I might construct a trade in here that I will share in the chat. So again, for those of you who don't have access to the OptionPlay app, there's a free trial for it. So I'm going to drop a link, or I'm going to try to drop a link in here. Actually, I'm going to just post the affiliate link in there, but you can get access to a trial so that you can actually work through these things yourself as well. So you don't want to get caught chasing. Interested in the long-term play, what you would look to do is, potentially buy a longer dated call option in the name, and then, potentially sell some premium into it. We're not going to have too many catalysts in the very near-term future. So, this right now, I've dropped in an 87.5 call. That's actually in the money. Yeah, does it have to be in the money? It doesn't really. I mean, we could actually choose the first out of the money strike if we like. And then you can just look to potentially sell some near dated premium against it. We saw here that, whoever this was who just sold the 7,000 lot, they seem to be happy enough to sell the 95 strike. So just using that as a guidepost. The thing is, I probably wouldn't sell the 95s myself at 75 cents, and the reason for that, and they can do that, they own the stock, they owned it for much lower. If they lose it at 95, which is up another 6-7% from here, works great for them. From my perspective, I'd kind of like to see a little bit more premium collection than that. Granted, that's only expiring in a week or so, but you're short a lot of gamma, the thing's whipping around. Maybe think about selling, as I've illustrated here, the June 95s, or you could even bump it up a little bit. But remember what I've said before, I'm looking to get at least 1% a month in terms of my covered call rights out of trades like that. You're going to end up with a position that looks a little bit like this one. Okay, so let's take a look at another name that was seeing a lot of activity today and maybe not so happy. Oh yeah, that's right. I'm sorry. I should actually share this trade. So let's do that. Okay, hopefully if I did that correctly, that should now be in the chat. Okay. So a couple other names that saw some unusual volume today. One of them we actually talked about, I think, on Monday, and maybe a couple of times before, and that's Starbucks. So interesting thing about Starbucks. So first of all, full disclosure, we own Starbucks, decent sized position that we have in it. Obviously, we're not very happy with how earnings turned out. However, I did notice a couple things today, and one of the things I noticed is that we saw a little bit of relative strength. So does that mean the near-term selling pressure is over? I don't know. I will tell you that, as a group, we have significant concerns about the way management is sort of dealing with things right now. So let's just talk a little bit about those. We'll talk about Starbucks and how we're positioning and how we're thinking about this right now. Things that I'm not happy about with Starbucks management. So we know that a leading customer complaint with respect to Starbucks, and the foot traffic being down, their sales are down. So the only thing that's supporting sales at this point appears to be higher average ticket prices, right? So selling less of what they sell but charging more for it, that's not a recipe that we really want to see long term. So I think they raised prices a bit too aggressively, and we might actually sort of be testing the limits of consumers' willingness to pay up for this stuff. I'm a little bit concerned also about the intent to solve that problem by broadening the menu. Broadening the menu adds complexity, and it could potentially create another problem, which is that we know that consumers have specifically complained about wait times in store and out. If you go to Starbucks locations, one of the things you're going to see is that they tend to have very long lines at the drive-thru. That's a problem. Another thing, so they're trying to add some flexibility with respect to what they're able to offer at the counter, and they're adding new machines which are a bit more complex, at least at the location closest to me. There's 2 locations close to me. Both have put these new machines in which allow them, rather than having the big vats. So for anybody who's gone into Starbucks recently, you'll know that they typically have these big vats of coffee. They would have maybe 3 varieties, maybe a light, medium, and dark roast. By the afternoon, they would typically be running maybe only 1 or 2 blends. So maybe it's just a light roast and a medium roast instead. So you couldn't get dark roast in the afternoon. They're adding these new machines which allow them to brew on demand. The good news is that means that if consumers wanted to have a dark roast, for example, in the afternoon, they can get it. The bad news is those machines are expensive. The bad news is they are complex. Complex coffee machines can have problems. The one closest to me, I understand, had a breakdown within the first week of the installation of that, when I imagine that's fairly costly. What I'm getting at is that I'm a little bit concerned that management is not focusing on the problem, which is speed, because consumers have expressed concern about that, and cost. So that's my biggest concern, focusing on things like lavender teas, adding more complex machines so that you have more variety, adding additional menu items when your consumers are complaining about price and speed. Doesn't seem like you're focusing your attention in the right area. So that's the bad news. What's the good news? Well, the good news is that theoretically these are solvable problems. And if you take a look at Starbucks valuation right now, and really what I was trying to get to is, why is the stock showing relative strength on a kind of a wobbly day generally? And perhaps this chart will show us that if we take a look at the historical valuation for Starbucks going back, call it 7, 10 years, we'll go back 10 years. So this is where we are right now. So I'm just going to draw a line to where we are relative to forward. So if you can see this white line, I'm going to, if I can do this properly. There we go. So this is relative to the trailing number, and let me just put it in relative to forward numbers. Now, granted, the forward numbers are coming down, okay? So I'm just going to go to the forward numbers here and draw another line down there, okay? These are 10-year numbers, so that's in yellow. Maybe I'm just going to get the trailing numbers out so we can take a look at that. There we go. I should have done that in the first place, right? So this is the street's estimates for, this is about as cheap as the stock has been in a decade. So I think I said on Monday, I really wasn't happy with what management is doing, and I'm not particularly. I think they are focusing some of their time and attention on the wrong things. It's the magical thing of the capital of a free market, though. You don't get to make these kinds of mistakes forever. And my thinking is that we might be getting closer to a near-term bottom. Do I wish I could get this at a bigger discount to the market multiple, like a 20 handle or maybe a little lower? The short version of that is yes. And do I think it's possible that one could start thinking about dipping your toe into the water here? And by the way, this just shows how quickly people's ideas on these kinds of things can pivot. Because I believe it was on Monday's live stream that I said no. Look, we had just taken a substantial hit in the name, and I was not convinced. But we did actually add a little today, not huge, but added some stock. We did write some calls against it, so. Bit of a buy right here, still a little bit of implied volatility. Don't have some immediate things coming on the horizon. But I think this is, it's interesting. I think one can start thinking about adding. Not a full, a full-size position. Now in our case, it was already pretty full-size, so what it's worth. Another thing you could do, of course, is what we have done before. And all of this bearish sentiment is essentially you're trying to buy into these dips a little bit. If you happen to believe that some of these management missteps are going to get corrected. What are some of the ways those could be corrected? Well, Jim Cramer was interviewing the CEO. It was not the kindest interview. Obviously, we're hearing some noise from Howard Schultz, as well he should complain, given that he lost $250 million on these earnings results. But they just need to get back to basics and focus on what they're good at. That's my 2 cents. And if they do indicate that, or if we get a C-suite change, I'm not saying that's going to happen, but it's possible. There's only so many missteps the street's going to take. Might be interesting. And actually, let's also do this. Let's just take a look at a long-term chart as well, just so you get a sense of the valuation that you're talking about. You can see just how dismal this looks, by the way. It's pretty grim. Now, bearing in mind also that we look at this because we write a lot of premium against the names we hold. So we're getting back, we're at levels. The stock has basically been trading in this range now going back 6 years. Even if you go back to 2015, it's not hugely over that, and on an inflation-adjusted basis, probably lower. So, still problems, not a perfect situation, but we're kicking the tires and adding a little. Take that and use it how you will. Uber. So Uber was another one that saw unusual options volume today. They announced earnings not well received. So why don't we take a look at what options traders were doing in Uber. This one traded 436,500 contracts. That's well more than 4 times the average daily volume. Makes it one of the busier contracts that we saw today. I'm going to just simply exclude anything. Same thing as before. I'm going to exclude anything that's probably just profit taking or unwinding. We want to go out at least until next week. This being the middle of the week, I don't think it's really all that pertinent to take a look at how people are going to be trading this thing into Friday. We don't day trade stocks, so I don't really have any special or unique insights on that. But if we take a look further out, we can see that the May 65 puts and the June 70 calls were the most active contracts. Now, these June 70 calls were actually in the money as of yesterday. So the question I'm kind of curious about is, were these people just blowing out? Or are there people who are adding into longs? What was going on there? June 57.5 puts there too. These things had decent open interest, so I'm kind of curious to see, and we'll maybe take a look at that. These May 77.5s, this is interesting because, and why is it interesting? Because these May 77.5 puts are now deep in the money. I would normally just assume that that is volume associated with, unwinding existing positions, except that notice that the volume significantly exceeds the open interest. So there's something a little bit curious going on there. And then the June 59 puts, which is substantially lower. So these two things I'm a little bit curious about. This one too, we also see that the volume exceeds the open interest. But what I'm really looking for is what is the first set of options where we see big volumes. Here again, this is very curious. We've got a lot of in the money puts, but let's just take a look at these June 59 puts first and try to get a sense of whether or not these are being bought or sold. So same thing as before. Usually you can take a look at implied volatility if you don't have an event. And if you see a big spike in implied volatility, probably a buyer. Big decrease, you can probably infer that it's a seller. That does not work when you have a big move in implied volatility for these other reasons. So what I'm talking about are circumstances where we have an event, like we saw in Vistra, like we saw last week in Starbucks, and like we saw today in Uber. Okay, so what was going on here? And one of the reasons, we don't happen to have a position in Uber, but one of the reasons I'm just happen to be talking about it, and then we're going to get to your questions, is that for lack of any other information, I'm going to assume that the chances that anybody who's watching this has a position in one of the stocks that we decide to talk about, it's much greater if I'm picking something that trades a lot of volume, has high open interest, and is typically one of the busier names. But that's why we have open mic. You guys can, it's an open forum, put whatever you want into the chat and we'll take a look at it. Okay, so implied volatility in this one down steadily during the day. This too, as we can see, just like in Vistra, we can see this isn't a lot of retail flow. This was an institutional print, also 7,000 contracts, took place at around 10 o'clock this morning, 10:56. 9:56. So we're going to take a quick peek there. What happened at 9:56? I'm just going to bracket the time slot here. $956.51, 7,230. Those traded at 59 cents. So we're going to do the same thing we did before. What was going on there? Actually, anybody go out indicated buyers and oops. Oh, it's nice to work at BTIG today. Those guys traded big blocks of this, 8 million shares. How much of that did they cross? They didn't advertise what they crossed. Okay. All right, so let's getting back to this. Sorry, for that little sidebar. Just curious to see who's writing the big tickets in this thing today. Did I just choose the right one? Yeah, I think so. That was these, right? Okay. And now I have to go back to the same time. And see what happened. All right, well, we can see actually just looking at these prices, we can already probably guess that was a sale. So there too, and that, unfortunate for them, it was probably a long sale on those puts. And what that tells you also is that you have at least one institutional market participant who, and I'm just going to See if I can find that print. Where is it? There it is. Yeah, so the market was 48 at 117. Let's just make sure they didn't clear any. You can see it right here, 956.51. Yeah, I'm going to guess that was probably, that one was probably a closing seller because we saw, but yeah, that's the only thing is that that total print was larger than the posted open interest, right? Let's just double check the size of that trade. 72.25. Can't be closing if that's more than the entire open interest that existed in the options to begin with. And I'm pretty sure, and that is. That is more than the entire open interest. So that can't be, that's not a closing trade. Interesting. Very interesting. All right, well, you know, maybe somebody thinks that, oops, that's the wrong contract. That's not going to be very helpful. I guess somebody out there thinks that there's actually the potential for further weakness. No opinion, no position in Uber, but we can take a closer look at that. So with that, let's take a quick peek and see if we have some questions, and we do. We're going to start with this one. What is your outlook for the energy sector, and what do you think of writing a June 7th 91.5 naked put on XLE? You must be eavesdropping. Ranjana Gupta asked that. Why do I say that? Because was actually looking at writing some puts on Halliburton. Okay, so XLE is not the same thing as Halliburton, of course. Halliburton is oil services, a lot of North American exposure, more than 50%. Oil services names, you kind of think about, what hits first when it comes to, drilling. It's going to be gas typically. So you drill a well, you're going to hit, gas is sort of the first thing, and gas has been exceptionally weak. Let me just pull a chart up and I'll show you that so you can see. So this is the NYMEX Henry Hub contract. But why was I looking at it? Kind of because it looked like it was hitting the floor. And so I started to think, okay, well, if we start to see this kind of level off, not great pricing, so this is not exactly a to-the-moon trade. I was thinking, all right, and folks who have followed me for a long time have known that I've traded in and out of Halliburton many times over the years. Used to be the Halliburton option specialist, actually, and traded the oil service index on the PHLX in the late 90s, and actually traded natural gas on the NYMEX too, as it happens. But so I like the trade. I was, we're actually completely underexposed to energy. I don't think we have anything in it, and it was part of we just making the observation that we're underexposed to energy. Hasn't been, some of it hasn't been great. So, yeah. And actually, let's pull this up so that everybody else can see what this would look like. So you are looking at selling the June 7th 91.5 puts. So I'm just going to stick that in, and that was the June 7th I think you had, yeah. By the way, Goldman just came out with a piece earlier this week. They had a couple covered call candidates. I don't think anything in the energy space was on the list. I'm going to take a look. I'll double check that. But one of the observations that Goldman was making is that they were just noting that index vol continues to come in, but single stock vol continues to go up. When you start looking at sector ETFs, that dynamic isn't necessarily going to play the same way. But this is the trade that you get. Looks like you would indeed be collecting at least the 1% that I was previously talking about. I'm actually just going to drop that trade in. Hopefully that went into the chat so you guys can go play with it. But like I said, you know, it seems like you might have been listening in on our conference call earlier today because, like I said, we were looking at the energy space. We're underexposed, looking to add and sell some premium because I don't really think it's going to be off to the races, but yeah, like that. Okay, so Kirk, Mazzy, bearish SPY trade that comes in after or before the Fed meets on June 11th and 12th. So should probably know. Yeah, so let's just take a look at that. So I'm going to put SPY. I'm just going to confirm what's on the calendar. And probably a good idea to start thinking about it now before that. So first of all, we've got, you know, next week we've got the PPI and CPI data. And I think, you know, although PCE, the PCE deflator is really the thing, you know, it's funny. Policymakers, they'll choose their inflation benchmarks to suit what it is they want to do. So are they looking at core? Are they looking at super core, PCE, CPI, whatever? The fact is that if the CPI data comes in hot, I just think their hands are tied because that is what sort of the whole wide world, that's what the public is kind of looking at. So with respect to putting on a bearish trade, if the thesis of the bearish trade, and one assumes this, right? Because the bull case is that, you know, inflation is going to get tamed and they have orchestrated a no landing or a soft landing scenario and that rates can come in. That's the bull case for equities, certainly one of them. The bear case for equities is that that isn't the case. It's not going to happen. Maybe it's not going to happen anytime soon. And although Powell's most recent remarks were extremely dovish in the sense that he seemed to take the concept of rate hikes off the table, if everything continues to come in hot, then I think that has to be acknowledged at least as a possibility. So we've got PPI next week, CPI next week. So those things obviously could come into play well before the June FOMC. And of course, at the end of the month, at the end of every month, you get the PCE date. So, okay. Couple ways you could play this. One way, of course, is just to buy puts. And, you know, what might something like that look? Maybe buy some, to keep it really easy, delta puts going out a month. That used to be sort of the box stock recommendation that, and I'm not saying that Goldman's the end-all be-all. I'm just happening to mention that they used to put these things out, and it was a 30 delta put that they happen to like. And that's a 30 delta put that expires at the end of June, as we can see here. Costs about $5.20, or give or take, you know, just rounding things off. That is going to be about 1% of the underlying. And it's pretty close, right? So that is the 508 strike put option, and we've got this thing trading we'll just call it 517. So you're buying a 1.75% out of the money put option that expires the end of June, and you're going to spend about 1%. So your downside break even at that point, 2.75. That's at expiration, but of course, any decent downward move, and you know, that should pay quite handsomely. So that's very reasonable. So again, we're going to just play the exercise, drop it in the chat. You guys can now toy around with that. However, it is also well known that skew, that is how much puts are bid over calls in index land, tends to be, there's negative skewness, so those out of the money puts tend to be a little bit more, shall we call it overpriced or more expensive? Doesn't really matter. So taking this original strategy now and saying, okay, well, why don't we try to take advantage of that and see whether we can't, turn this thing into a put spread instead. Maybe we'll look to put on something like this. Okay, I'm not going to buy both of those. That's going to look like this. So here I've actually got a $15 wide put spread, and that is going to look like this. So now the outlay is about $2.70. So you're looking at a little over 0.5% of the underlying. So one way to think about this is you could say, okay, well, I could buy one of those puts and spend $5.20, or I could buy two of these put spreads and spend $5.40. And if you're looking out to June expiration, downside of 493, so 493 over 517, which is where we are now, that's targeting about a 4.6% downside move. Now I realize that a 4.6% move over the course of well over a month, right? Because we're still early May now and we're looking to the end of June. May not sound like a lot, but actually a 4.6% down move for the S&P is pretty considerable. So that's another way to play it. One quick thing I would say is that lately I haven't been using put spreads myself. Partially that's just because we've got the other stocks on, and I'm not looking for insurance on our SPX options to hedge an equity portfolio in the event that it moves down between 1.5% and 4.25%, right? For a predominantly long equity book, that's not the risk. Stocks fluctuate. We can tolerate moves of 1-2% this way or that from 1 month to the next. What we can't tolerate, or we certainly don't want to tolerate, are really big moves to the downside. If we suddenly get disastrous news and we get a Q4 2018 scenario. For those who don't remember, the S&P dropped, I think, more than 20% on that. That was the taper tantrum. And the taper tantrum is maybe, arguably, it's the best kind of risk case that we can think of, right? It's the perception by equity investors that you're going to get a scenario that is not as accommodative as you would hope from the Fed. Let's take a look at how the market did that year, by the way, because I think it will be kind of interesting. And say, okay, if the market doesn't get what it wants from the Fed, this is what happens. Now, taper is a lot, and by the way, the Fed's still buying bonds. It's not like it has been a complete disaster, but this is what happens when equity markets really get upset and don't get what they want from the Fed. And what did we get? A 20% decline, right? So this is the kind of thing that long equity investors who are basically, long, large mega cap stocks are trying to avoid, especially, because what are you doing? If you're long stocks and you're selling calls against it, what are you really up to? Synthetically, you're just selling puts. Covered call is a short put. And there are times when short puts really are painful, and this is a good example of that. So if you're trying to get a hedge in or bet that the market's going to roll over on disappointing news from the Fed, isn't this what you're really betting on? So it doesn't happen a lot. I mean, how far back did I have to go back? I had to go back to Q4 2018, to the taper tantrum, to really make my point. But this is a period right here. So this period right here is 17 trading days, and the stock and equities fell 9%. Here's another period of time, 12 trading days. And the S&P dropped 14.5%. And over this entire thing, peak to trough, 57 trading days, we dropped 20%. The put spread that I just talked about, or the puts I just talked about, are really more tailored to these shorter types of moves. And this is about as severe a move as you could really realistically expect in that time frame, unless you get something like a pandemic plunge. And that's a different kind of a market dynamic. Here too, another time frame. We're talking about 10 trading days, so that's two calendar weeks. Get a 9% decline. Yep. Okay. Sorry, I'm dragging. So thank you, Mr. Producer, for letting me know that I got to get on with it. Okay. Long hood bought 517, 1716 put spread and bought the May 10th 1x2 19.5 20 call spread. Net cost 8 cents. Stock up after hours. How to close this tomorrow if stock opens below 16 or above 20. Maybe somebody who's in my ear can tell me where they see hood trading right now, because I don't. Oh, actually, I could probably pull this up. Unfortunately, I don't have, not every single one of the machines I've got, and I logged out of this other. So 17.85 is what I'm hearing. I'm going to pull up this other, NFT one. All right, so I'm going to pull up some stuff on the other side. I shouldn't have shut that off before, so I get my real-time quotes after hours. Okay, so let's do this. So the first thing we need to do is let's create this trade in here so we can all look at this thing together and see what it looks like. So we're long hood stock. I'm going to just modify this one here. Just going to put the stock in it. You're long the stock. And of course, by booting up these other machines, I'm covering up the things I need to read. Let's close that. Okay, so what do we got here? Long the stock, you long the 1716 put spread, and that was the May 17th, so we'll just go to May 17th, 1716 put spread. Adding that in. I'm going to assume mid-market prices. And then you also have a 1x2 19.5 20. It does not sound, based on what I'm hearing, like that upside's really in play. Okay, I might actually be adding too many legs. That's all right. I have another application where we can take a look at this. I don't think that long call spread is going to end up being in play. Not if the stock's trading below 18 now. It would be quite a run for it to trade up $2 from here. That is my guess. What did we get out of them? So that's a comfortable beat. Why isn't the stock up more? There must be something else happening. Yeah, we did talk about this earlier in the week, that they had that they got a Wells notice, and we talked about that on Monday. And it might make sense, listen to the conference call, but as I said on Monday, probably going to get some on the advice of counsel kind of stuff, not really going to offer a whole lot. I don't think you need to think about the upside. I actually think that you may have essentially threaded the needle. So you basically had you had a booster with that 1x2 call spread, and you had some insurance on that 1716 put spread, and you basically paid nothing for it. It sounds like about 8 cents, and it's going to land right in the middle. So actually, I don't think you're going to have to worry about it. Okay, so let's see. Okay, how can I get my hands on this software for all these charts to track options trades? That's from Algover. So are you? I don't know if you're talking about. Okay, yeah, you may have been. So the system that we'll just go back to it really quickly. So when we share my screens, sometimes I'm sharing the OptionPlay app, which I find to be really the easiest tool for just really quick trade construction types of things. This application is, and most of you are probably familiar, I think I've mentioned in the past, this is Bloomberg. This is a Bloomberg terminal, Bloomberg Anywhere. I don't have some relationship with them to promote their product, but it is expensive. So be prepared to shell out, depending on the market data that you get with it, it's probably going to cost you $30,000 a year plus for this one. But I don't think you need it. I have grown to depend on it simply because I've been using it for 20 years. And they've enhanced the product pretty regularly, but it's not cheap. So if it may not be useful in your context, but it has a lot of great stuff. And some things really weren't good in Bloomberg terminals before. I can remember when I would never have used it for any kind of volatility data. And it incorporates things that I don't know that institutional traders look at that often. I'm pulling an example up right now because it's not something we typically looked at that much or thought about, especially when we were market making, because we didn't need to estimate how much gamma exposure there was by strike because we were the ones that were carrying it. So that kind of information wasn't all that helpful. But they've got things like GEX data in here now, which I thought was an interesting add. They have nice visuals for volatility, and their volatilities have gotten way better than they used to be because, call it 15 years ago, these things were nigh unusable. So you can do things like visualize the volatility surface, which is kind of nifty. You can track the implied volatility of options through times, although we have other ways to do that, and hopefully we're going to add that in. So that is that. Okay, so FinWest says, sorry, Mike, YouTube deleted the first part of my comment again. And then said, perhaps I'll try hitting you on Twitter. So FinWest, yeah, go ahead and look, I don't respond to everything on Twitter, but if you guys want, you can follow me on Twitter at Michael_KHOUW. And, if you send me a direct or, I'll try to respond to you there if I can. Okay, so let's see here. Michael Kasich says, Schultz needs to come back. Yeah. I mean, how many times can the guy come back? It's like every guy to replace him, it's a false start. It shouldn't be this tough. And the guy can't run the company forever. I don't really know what to make of it. I would think there is... Yeah, I'll never say never. He's not even on the board, I don't think, anymore. So, but I will tell you, it's not just from Schultz. I think there's a general lack of confidence right now. I'm not going to say that they can't pull it together in the C-suite over there at Starbucks. I hope they can, but they're on thin ice. I'll put it like that. I don't have any unique insights on it, but that's how it strikes me right now. Here we go. Fred asks, sold a bear call spread on UNH June 7, 24. Weekly, 3 contracts. Short, the in the money 490, the other is the 510. Hold or bail out 30 days till expiration. So actually, let me put, I'll put that one in to OptionPlay. Do I leave my microphones on or something? Because it seems like you guys are looking at the same stocks I am. United Health, so we have positions in United Health on the long side. Long really liked this company from a fundamental point of view. My CRT Capital days, our head of research was a woman named Cheryl Skolnick, specialist in the space, loved the company, ultimately ended up working there. I think she was now an executive at United Health. I like the company, like many in the managed care space, under some pressure. Interesting that you should mention this, because today we were looking at United Health and wondering whether or not we would add some longs. Decided not to, because while we like it fundamentally, short term we're a little bit concerned. And actually, while I don't happen to look at things like GEX, there are some who do. Those numbers are not particularly positive. So you are in a short call spread, which is the same as a long put spread effectively. And I'm just going to go to this particular expiration. Whoops, I should have just changed it on both. You are short the 4. I mean, this is basically dead in the middle, isn't it? I remember I was looking at the stock earlier today. I think you're basically in a 490, 500, 510s. So here we are. Look at this. Okay. So I think this trade's actually still in a good spot. It's not my habit, by the way, to make a call on where a stock's going to be tomorrow or the end of this week or even the end of next week. Generally try to trade around a fundamental view and, dig into a story a little bit. And in some cases, if we have that story not quite right, which I think is fair to say we didn't have it quite right in Starbucks, we're reevaluating it. United Health, we like it on the long side. We own it. We're thinking about adding it today. We did not, because we did indicate some potential for short-term weakness in it. I don't know if that helps you, but the position is fine if you share that view. So I don't offer 2-day, 7-day, whatever trading advice on stocks. I have no idea what stock's going to do in that kind of time frame. But I will tell you that we did not add because we saw some near-term weakness. That sounds like I'm talking out of both sides of my mouth, but we are looking for a slightly better entry point. And actually around, below 490, I think 485 was where we were thinking, and that's not a big difference, $15 on a $500 stock, but I hope that helps you. I think the position's in fine shape right now. Okay. On Uber, bought at 956 at 59 when bid ask was 48 117. Stock jumped. It was below 64 earlier. Could be bought, or my son is just popping in, which means it must be getting close to that time. I apologize. I'm Tommy, you can wait. Tommy, you can wait for me outside.
No, I'm upset.
What's that? Okay, you guys can. Okay, what are you asking me for?
Do you have enough points?
Here, step outside. I'm on.
I spoke to Mr.
All right. Well, that is live television, folks, or live YouTube, live stream. My office is walking distance from one of my kids' schools, and he just popped into the office and decided to not say hello to you all. So I'm going to go see what he wants, and thank you guys for spending an hour listening to me ramble on. about options. And I'm going to try to, there's a lot more questions here, so, and comments. I'm going to try to get to some of those when I can, and maybe we'll address them on the next live stream, which is going to be taking place right here on Monday at 4:15 Eastern Time. Thank you for your time and attention, and thank you for putting up with that unintended interruption. See you later.